Hi, everyone. Welcome to SoFlo Real Estate Show. It's August 21st, and we have a great show in store for you today. One of the things we've been talking about is everything getting ready for getting a home loan. What are the interest rates, how to shop for interest rates, how to get a pre approval. But the one thing that we haven't discussed is why do so many loans fail to close on closing day? Buyers are sitting at the table expecting the keys to be handed to them. And why would a lender at that very point in time say no? You're not going to get your loan. You're not going to buy your house. Well, on today's show, we're going to share the 5 reasons why homes fail to close on closing day. By the way, if you like what you're hearing, go ahead and share the video or subscribe to the show. By the way, my name is Athena Chilicas Barrocas. I'm a top producer and award-winning realtor with Coldwell Banker here in sunny South Florida. I've been selling luxury homes for over 20 years, and I absolutely love my profession. So before we get started here on the huge discussion, I'd like to invite back my beautiful guest and my really good friend, Julie Dinda of Radius Financial Group. Julie, how are you today?
I'm doing awesome. Nice to be here.
It's always nice to have you back. You always come in, you're sharing some great information for our viewers. And today we're going to be really talking about something that's important, and it's somewhat a mystery too out there. You know, as we look at taking the buyer through the home buying process, we work so hard as a realtor, the buyer, and the lender to get the pre-approval, the application in place, go out shopping for a home, find a home. In today's market with a limited inventory, we're competing with multiple offers, right? It's really, really hard. We finally succeed, and we're bringing the lender in on this process, and we're going through it. Now we're in this for what, 30, 45 days, Julie, before we're at the closing table.
Yep,
That's a
unless you
long
need to
time.
rush it.
Unless you
Yeah,
need to rush it. But we have title, we have things going on, we have HOAs. So for
yep,
the most part, it's a good 30 days. It's a
pretty.
good
Yep,
30 days.
yep.
And during that 30 days, a lot can happen on a buyer's side, both financially, personally. And, we just have to make sure that we're very communicative with our buyers. I know I am, I know you are, but, there are times where a buyer comes to a closing table and they walk away unsuccessful. And that's what I
Yeah,
want to talk about
yeah,
today.
there's so many moving parts to a loan. It's not just a find the house, get the money and go home. There's so many moving parts, and so they all have to, the pieces all have to fit together for the closing to be nice and clean and smooth for sure.
It does. That's what we strive for: a stress-free
Free,
closing, right?
correct.
Stress-free.
Yeah.
And you and I take on the burden of most of that stress because we're working behind the scenes. So
Yes.
tell us a little bit about what happens behind the scenes after a buyer has already gone through like the first 10 days of the loan purchase process, and they still have another 20, 30 days to go. What takes place with the lender behind the scenes?
Yes. So there definitely is a lot, but I wanted to kind of let you know of a statistic. So NAR,
Ah,
which is the National Association of Realtors, did a statistic where they talked about the loans and what closes and doesn't. So 73% of loans are closing on time. 22% are going to be a little delayed for whatever reason, and then 5% of those fail to close altogether. That's a kind of a good statistic to kind of to know before you go into the process. So behind the scenes, what I would like to say is, again, there's so many moving parts. Once you fill out your application and everything's in and great and good to go, what we do is we put together a file. So it's called a bite file. And in that file, it gives everyone access to it. So your processor, your underwriter, your closing team, the person that's getting your HOA information together, your insurance, the insurance department, everybody has access to this file, and it's kind of like your grail of sorts. And so, when once we fill out the application and everything goes in and everything's beautiful and we submit it, it's going to go to someone called a processor. So a processor is essentially an assistant to the underwriter. So they're going to take all the information that you put into your application, and they're going to make sure all the documentation that you need to prove that. So, where you work, how long you've been at your job, like what kind of debts that you have. Did you pay off your car loan? Did you pay off this? If it says that in your application, the processor is going to come in and get all that information from us. Once he has all of that put together, they're going to wrap it up in a beautiful little package and deliver it right to the underwriter.
So that packaging is really important.
Very, very, very important. Yes.
Very important.
The more information that you get in the front end and you can put into the underwriter right away, the more conditions that we clear. Because essentially there's probably 100 conditions when you buy a house, and every single little piece of information clears that condition. And once that condition's cleared, we never see it again. That's what we like to do. Just clear, clear, clear.
Yes, we do like to clear, clear, clear. And, there's a different points within the process where the underwriter is going to come back, the loan officer is going to come back and ask for information. And it's so vital that that information is not only given, but it's absolutely accurate. Because we don't want anybody not to be able to fund. But going back to that statistic, Julie, that's pretty amazing. 22% are kind of like, needing more information, which is really risk. And 5%
Yes.
are like no go. So we're talking about almost 27% of home loans going through the process are at risk, with 5% pretty much not closing. Those are big numbers.
Yeah, and essentially the majority of the reason that that happens is that the file does not get to the underwriter in time, meaning the buyers
Mm.
don't supply the information fast enough, the title company is not getting the information over to us fast enough, the insurance company. Once everything's nice and beautiful and that package is complete, you should be getting that package into your underwriter 2 weeks before closing so that the underwriter can see any potential problems and let us know about it right away.
That's a good rule of thumb. So I hope everybody heard, immediate response to your lender request is only going to help you as the buyer ensure that your loan does fund on closing day. So Julie, let's get to it. Let's talk about the 5 big reasons. We could say most of this is non-buyer fault, but there is buyer culpability in this process as well. And there's 5 things that happen over time that sometimes we're just not aware of as consumers, how it can affect the outcome of our home loan. And so I like to go into that. I'll name them, and you can tell me from a lender's perspective, Julie, how that impacts their loan. Does that
Absolutely.
sound good?
Yeah, I
Okay,
love it.
let's get to it. Let's get
I
to it.
love talking.
Okay,
Let's
the first,
prepare.
let's prepare. I love it. So let's talk about a buyer's in the process and they decide to make a big purchase, right? A big purchase. Now we can say we're not talking about the mega yacht here, okay? No, we're talking about what? Maybe a new car,
Furniture.
right?
Furniture.
Furniture. Furniture's a good one. Oh, you know what? That is a really good one
Yeah.
because as a home buyer, and I've seen this, as a
So
home buyer,
excited.
you're like, I want to go out and get that furniture, and I'm going to go to the store. I'm going to get 0% interest, right?
Yep.
Because it's
Only this
Memorial Day
weekend.
weekend, right?
Only
Only
this
this
weekend.
weekend.
I promise
Zero
you they'll do it
percent
next weekend.
financing. It's so true. 0% financing. I'm going to go in. I'm buying my new living room, my new bedroom, my daughter's new pink pretty room, whatever it is. And then what happens, Julie?
So what happens is you go and you get so excited and you can afford it and you've been saving your whole life to buy a house, and you go in and you buy, the leather and the nice, and all of a sudden now it's a $7,000 thing, but it's great because you did it this weekend and you don't have to make payments for 6 more months, but the payments when you make them is $575. Well, that $575 is now going against your debt to income ratio. So if you
Mm.
were tight, if you were like right there, that could push you to a point where your debt to income ratio will go over the 50%. And if it does, you can't close.
Wow. Just like that.
Just like that. I mean, unless you return all the furniture and do all that. So just don't do that. There is a way you can get around it. You can cancel it. You can say, don't deliver it. I'm out. But now you've pulled your credit and now you've got all that. And now you're going to have to do it again at the end of closing. Just wait to buy big things until we get that clear to close. Then I don't care what you do.
Well, we want them to have nice furniture, just
Yes,
not during the loan process. And,
exactly.
it's really important. Don't buy a new car. Don't buy furniture. What are some of the other things you've seen, Julie?
Yeah, I mean, sometimes people like the car. I've had a situation where someone came in to fix their car and they were like, "Oh, hey, you're good on your lease. This okay, so your lease is I'm going to put you into another car, okay, but this car is going to be
Mm.
cheaper, so now you're only paying $400 a month instead of 575, and you're like, oh, that's great, it's less money. Not great, because what happens is now because you haven't paid off, because the car dealer has not paid off that first loan yet, you now owe two cars. So now you're at $750 debt to income ratio, because until that car is
Oh,
paid off,
wow.
yeah, until that car is paid off fully, it's still on your credit and you still owe that money. That actually happened. And we had to wait 60 days for the car person to close the loan, or to close out the car, so that we could finally close on the property. Thank God it was a refinance, so it wasn't a huge deal, but you could lose the house and you could lose your deposit for something like that.
Yeah, no, that's true. I did not realize that a lease, you have a lease and you go for a different lease that's less. It considers two loans until it's all
Yeah.
cleared out through the auto company.
That's why you
That is
always just ask.
incredible.
Yeah, always just get in the habit of ask, 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 ask.
Yes, that's what I always advise my clients. If you're going to do anything, you must
Anything.
ask your realtor and your lender together, because we both have different ways of looking at the same scenario and maybe provide different ways for an outcome. But at the end of the day, if the lender says no, it's pretty much no. So thank you for that, Julie. Those were some really good examples, and they're real examples because I can see it happening.
Yeah, it happens all the time,
You're right.
unfortunately.
It
Yeah.
happens all the time. Here's another one, another top one. Applying for more credit. If a consumer applies for another credit card, another loan,
Yeah,
how
so
does that
sometimes what
impact their ability?
again, it's kind of the same, case in point. People tell me all the time, they're like, yeah, I want to put more money down, or I want to put, I want to, instead of putting 5%, I want to put 10%, so my interest rate's down. So I'm going to go and get a credit card, and I'm going to pull all the cash out of the credit card, and then I'm going to go ahead and use that. Again, that goes against your debt to income ratio. So first of all, you can't use it because it's an unsecured line of credit. So, you just did it for nothing. And then on top of it, now that $500 payment again goes against your DTI. So anything that goes against your DTI, you do not want to do, especially if you're really close.
Right, right. So that's really important. I don't think most of our I know when I started buying a home, I didn't really consider DTI. Being in real estate for 20 years, DTI is, one of my favorite acronyms when I'm talking to my clients. It's funny how that happens. But, it's not something we're cognizant of as
Right.
individuals,
So debt to
you know?
income, DTI is debt to income ratio. And the best rule of thumb, the best way to think about it is you take your income that you make and the debt that you have, and you take 50%. And anything above 50%, you're out of your debt to income ratio. So, easy math, $5,000 you make a month, your housing expense, your credit cards, anything that shows up on your credit report cannot be more than $2,500. $2,512 will make you not close.
Wow. Okay. I hope everybody heard that, and we'll put that DTI into the comments below for you so you can make sure you remember that. But she's absolutely correct. Like I said, I've been selling real estate for 20 years, and consumers making choices on their own when it comes to income, when it comes to credit, when it comes to purchases. Anytime you're in a loan for a home, it can really be detrimental. And there's sometimes where you'll have to just simply pull out and wait 60 days, 6 months. And then in this market, can you really afford to buy that same home? Probably not. So, I hope everybody is really paying attention because these are great pieces of advice, Julie. Um, Here's a third one: job change or loss of employment. That's a real concern. We have a lot of individuals out there changing jobs rapidly now, more mobile, more we call more entrepreneurship. We have more sales that are in more commission based. So there's a lot of influx as far as change of employment right now. What do you caution our audience on when it comes to home loans?
So I caution the fact that if you do not have to make a change or there's a change that you're looking to make, do it after closing. Because after closing, we're not coming back and trying to figure out what you can do. So if at all possible, do whatever you're going to do after closing. Well, we live in, a not fair world sometimes. So unfortunately, things happen here and there. What I'm looking for as a lender is one, if you have to change jobs and you go to the exact same job for a different company, let's say you're a dentist, right? Or you're a dental hygienist, and you leave one dental hygienist and you go to another dental hygienist, as long as there's a pay structure, usually what happens is Fannie or Freddie like to see about two solid checks. So if you get paid every week, as long as you can show two solid checks that don't show too much of a change, then that maybe will slow down your closing maybe a couple weeks. Now,
Mm.
let's say you work for a huge company like Tesla, right? You've been working for Tesla for, since they opened, right? And you're like a, big manager, you do all kinds of great stuff. So you're making $150,000 a year. You're like top of your game, right? And then Elon comes to you and says, I need you to run my sales division for all of North America. Okay. I'm going to pay you, $100,000 base, and then you're going to make all this money in commissions, right? So you went from a W-2 to a commission. Well, as a lender, that's a lot of risk. I don't know if you're good at sales. Who knows? Who knows if you could even talk to people, And so I don't know. So what I would need in that case is 3 solid months of pay stubs coming in. 3 months. So again, if you're going to make that big change, you say, hey, Elon, I am so ready to make this change in 3 weeks when I close on my house. So try and just kind of keep that in mind.
That's a good point, though. We think we're getting more money, perhaps, right, in changing jobs, and it puts us in a better perspective or in a better light for a lender. But the reality is, you're looking at risk as a lender regarding
Correct.
employment, and not
Mm-hmm.
necessarily is the person going to be making more money.
Exactly. Exactly.
How does this work with entrepreneurship? Say you have a job and you decide you're going to open your own business.
So that's a rough one. So when
Mm.
you decide to open your own business, you're going to be paid in a different structure. So W-2, you're guaranteed, we're going to be able to see what it is that you're doing. If you own your own business, I'm going to need 2 years. Some programs allow me 1 year. But not many. So you would have to, and your interest rate would be extremely high because remember, it's all about risk. So how do I know that you can be a good, you're a great employee, like you're really, really great as an employee, but how do I know that you know how to pay your bills on time and handle your mortgage and balance your checkbook and make sure that you're making money and that you have the client list? I don't know that. And the only way that I will know that is 2 solid years of taxes. And again, obviously there's every one of these situations, there's a way out because you can get creative as a lender. You could do, bank statement programs, you can do this, you can do that. But at the end of the day, for you to be able to close in the terms that you've closed in, whatever you're doing, wait until after closing.
Yeah. So basically, if you're a W-2 employee and that's how you went into your loan package as a W-2 employee, right? You're working for a company, they're paying you every week, every 2 weeks. And then you decide, you know what, I want to open this business, a nail salon. It doesn't matter, right? A hairdresser, a restaurant, any kind of business that you yourself are operating. 2 years, you cannot buy your house that you are under contract for. It's an
Correct.
impossibility. And that's a very good reason why a lender will say no at the closing table. But 2 years, Julie, that's a good number for us to all remember if we want to open our own business and
Correct.
then look for a loan. And
Because
remember, you know,
most companies, even the 1 year is going to be tough because you have to be established for 5 years to be able to only use 1 year. So that kind of null and voids what you're trying to
oh,
do.
okay,
So
so we're
yeah,
back to 2 years.
so 2 years. Yeah, I don't have any
We're
programs
back
right
to
now.
2
Just kidding.
years. Oh my goodness. But thank you again. Those are real good examples,
Yeah, and
and
it's
you know
back to the
they're
moving parts.
realistic.
Yeah, it's
Yeah,
back to the moving parts. There's so many moving parts. If you do this, you can't do this. If it's like this, you can't do that. And that's what the processor and the underwriter are going to tell you is, oh yeah, this looks great and beautiful, but because they do this, this, and this, they have to do it this, this, and this, you know? So,
right,
mhm.
right. And again, risk. We have to remember that it's not always about making more money during the process.
Correct.
All right, let's move on to this one. Home appraisal is less than the offer price. So we put in a $700,000 offer price. The appraisal comes back at 620, $80,000 gap, right? And so, I just want to take us back a moment. When we purchase a home as a home buyer and we're at the appraisal process, you have three options when an appraisal comes back. If an appraisal comes back at your offer price, for the most part, the transaction is going to continue to move forward. If the appraisal comes back higher than your offer price, that's a beautiful place to be because as a buyer, you have built in equity. So again, 700 was the offer price. It comes back at 740. The seller doesn't get $40,000 more money. Nope. You get $40,000 in built-in equity. You as a buyer are excited. The lender is happy. Everybody is happy at that point. But there's also a third outcome, and that's the one we're talking about today. Offer price 700,000 is the offer price, 620 is the appraisal. No good. So what happens is you and the seller can negotiate. You can walk away with your deposit at that time by canceling the contract. But let's talk about on the lender side, what happens at that point, Jolie? Tell us a little bit about low appraisals and how that affects and what can possibly be the outcome.
Sure. And I'll use a third party story with you included. So, most of the
Oh,
time, you want to have, when you're working with a great real estate agent, what'll happen is the real estate agent is going to know right away, this is not going to appraise. Just, Julie, we're putting in this offer. This is what they want to put. They want to be in. But just so you know, all the other houses in the area are going for this, and it's going to probably appraise 20,000 less than this. So in preparation for that, I'm going to talk to my buyer and say, hey, listen, there is a high possibility that this is going to come back lower. So I see that you're putting 20% down on your loan. Okay. There may be a situation where we're going to need you to put 10% down, and we're going to need to take 10% of those closing costs and put that towards your appraisal if you want this house. Okay. Now, of course, you're going to have your realtor is going to, negotiate and say whatever. But at the end of the day, I, as a bank, am not going to give you more money than a house is worth. So if this house comes back at 640, I can't remember what we were saying the price was, but
it's
let's just say the house, you put it at 680 and it came back at 640, there's a $40,000 swing that you will not get a loan for. You are only going to get what the house is worth. So anything over and above that, you would be responsible for.
Yeah, and that's true. We've worked together many times, and as a realtor, I get a very clear idea of whether or not your offer is going to come in at appraised value. Sometimes you have to put in an offer above, just in this market because of the competitive nature. But working with your lender as well to make sure that the package is able to move through as we negotiate through it is so important. Now, if you only have a 3% down, Julie, and the appraisal comes in lower, there's very little room to, from a lender's perspective, to really do anything at that
But
point.
and a lot of the times the seller just thinks that their house is worth so much more money, you know, but at the end of the day, once the appraisal is done, especially on an FHA property, it's out there. That
Mm,
is what the house is worth. So unless somebody wants to put money down, like unless somebody wants to pay over and above, which sometimes they do, great schools, great cities, great communities, they will do that. But at the end of the day, the seller's not going to get more of a loan than that. Then when they accept more offers, they need to know that they can only accept cash over and above that amount. And sometimes just
right.
having it on the market for a longer period of time doesn't make sense. It's like, hey, I've got a person, they're here. And that's what helps with a lender like me that's very like I'm talking to the seller's agent, I'm talking to the buyer's agent, I'm talking to the buyer, like I'm all over the place. So, I'll have a conversation with the seller's agent and say, hey, not for nothing, but if you take this off the market, you're paying 10,000 a month in taxes. So just give them the 10,000 because at the end of the day, you're not making any money off of this. It's only going to hurt you putting it back on the market for another 2 months. So you got to be able to negotiate, and sometimes that can happen. And then, like she said, you're getting a great value for the house, less than you thought you were.
Yeah, absolutely. And the negotiation is is really where your realtor comes in. We know the market, we understand the financing, we have our great lenders there to assist us and give us an overview of what they're seeing. And so it's just really important to have a good team around you. But when we come down to it, it's one of two things. Either you put more money in to keep the house, or we offer a lower price for you. But at the end of the day, it's out of our control, it's the seller's control. But the appraisal is a huge piece of why a home may not finance on closing day. So keep that in mind. Let's go to another hot topic that is out there, Julie. Home inspections and major problems identified with the home inspections. And this is important because lenders, again, it's all about risk. And lenders feel that a home should be safe and should be healthy. And when those two things come into play and there's items that are identified that are not health and safety, then they get the red flags. So, Julie, why don't you talk a little bit about how that works from the lender perspective?
Yeah, so we want you to be moving into a house that does not have holes in the ceiling, that, doesn't have mold, you have something like a challenger box or like um drainage issues, structural issues, if there's wind mitigation issues, that's going to be a huge problem. And there's a couple things that you can do. Sometimes, if you talk with the seller, they'll rectify those before you close. And that's all I really care about. I mean, obviously, I'd have to have another appraiser come in and make sure that it was done correctly and everything looks good to go. But this also, and I know that we're not really talking about it, but we'll kind of talk about it from the condo perspective. So inspections as well come from me looking at like a condominiums, like their rules and regulations and all of that, and what their
Mm-hmm.
budget is, and all of that is very important to us because we don't want something to happen along the line. Let's say you're very close, and we'll go back to the debt to income ratio. Let's say you're at like a 50%, right? And you're right there, you're barely going to pay your house and all your bills on time, right? And what we want to do is, if heaven forbid, if you need to buy a new roof in a year, how are you going to do that? Like, it's going to put you into a position where, one, you may need to sell, two, you may put yourself in a situation where you can't pay your bills and you'll have to foreclose on the property. And we don't want that to happen. So we make sure that the house is structurally good, the house is everything good, and not for nothing, but we own the house until you pay it off. So I don't want to buy something that doesn't it won't maintain its value over the years of you living there.
That's a good point. Who owns the home? It's a partnership between the homeowner and the lender. And, at the end of the day, the lender really does have the say in whether or not they're going to fund. So, I have a great example. We were negotiating a home. She found a beautiful home. It has a lake. It had everything they wanted, Julie, right?
I know
Everything
this
they
one.
wanted. I know you do, right? Everything they wanted. But it came back, the house had poly pipes. No insurance company is going to lend on poly pipes. The lender doesn't want to even hear poly pipes, right? You don't want us to tell you the house
I
has
didn't
poly
hear it.
pipes. No, don't want to hear it because the lender's going to say, no, we're not going to give you the money. So what do we have to do in that case? Well, as a realtor, understanding the situation, understanding, the cost, understanding that these poly pipes have to be remediated, meaning that they have to be replaced prior to the loan closing. And who repairs the house? The seller repairs the house. A buyer doesn't repair houses that they don't own. So we had it remediated. We had another inspection come. The inspection report was given the okay, no poly pipes, and then it was passed over to the lender. The lender saw the report, no poly pipes, and everybody was happy. But had the seller not gone through that, there's just no way a lender's going to lend on that. Correct, Julie?
Yeah, we will not lend on a house that can't get insurance, and you are not going to get insurance on that house. It's the same thing with, like let's say like a roof. Like if the roof is less than 3 years, you're not going to be able to get insurance on the house. And if the house can't be insured, we can't give you money for the house. So yeah, I mean it's definitely something. But again, when you have a great realtor and you can go in and say, hey, not for nothing, but you're going to run into this problem with every other offer that's going to be submitted to you unless you fix the problem.
Yeah, and listen to this. I was at I hosted an open house recently, and that roof is original. The house went through a couple of buyers, still on the market. It's been on the market too long, and this market too long is 30 days, right? It's been on
Right.
the
I was
market
going to
too
say,
long. The agents started to get offers that are lower. And so when I was hosting the open house, they said, what are we doing about the roof? The roof is original. The seller's going to give half credit. Half credit. I'm like, half credit? Okay, if the roof costs $40,000, the seller's going to give $20,000 credit. That's $20,000 more the buyer has to come up with in order to get the roof repaired, which cuts maybe into their DTI, which has other ramifications. And so, Julie, I was like, oh my God. I said, well, if I get a buyer for this house, you're going for 100% credit. You can't do anything with 50% credit on a roof.
yeah. Or offer $20,000 less.
I know.
Yeah,
I'm just
no, it's
saying.
crazy because nobody has 20. Like, I mean, if you've saved your whole life to buy a house, who has $20,000 just sitting in a checking account ready for a roof? It's just, they
Yeah.
don't. So, but
Some buyers do. You see some buyers come in and they buy the house and they got it and they put 200,000 in. It's a
yeah,
beautiful home at the end. They put in
yeah,
a new pool for another 100,000. But the majority of buyers coming in and buying homes between 5 and 700,000, they're not the ones with the 30-40% down
yeah.
payment.
And the people
You
that have
know?
that money that were planning on putting the 200,000 in it, they're ready to offer 20,000 less. That
Yeah,
those are the people that offer the $20,000 less because they're like, hey, I got to put all this money in. So at the end of the day, the seller is going to be losing out on that money. Where they could have just fixed it and asked 20,000 more for a
I
brand. Hey, we just
know.
did a brand new roof, $30,000 more. And
There you go.
sometimes sellers don't think about that, or sellers don't have the cash either. So,
That's the thing, like a roof, that's a very expensive item, and it's not like you can just go out and get financing for that. It's not that
yeah,
easy.
we had to change.
So,
Last week we had a same exact situation like that where they came back and they could not get so the inspector said, because the inspection is done at the beginning and the appraisal is done a little bit farther into the process, but the inspector said that the house had 5 to 7 years on the roof. But when the appraiser came in, they were like, no, they don't. It's about a year, maybe. And we had to
oh,
change the whole entire contract around to a construction loan. Yeah, essentially like a construction loan where they're going to be able to, roll the cost of a brand new roof into the house itself, and it's all a part of the loan. But that
right.
affects your rate and everything like that. So
Yeah, it changes things up. It
hmm
does. And it puts the contract at risk,
yeah,
the purchase at risk. And, that's the one thing we're trying not to do. But,
that's the 5% we're
these
staying
things are
away from.
happen. And this is the 5% we're staying away from. So roofs. Another one is your box. Your electrical box, right? the Challenger box. That one there is a big one for inspections. It's a big one for the lender. It's one of those things that must be remediated. So, when you're looking at your home and you're thought, this is my dream home, work with your realtor to make sure that these hot items for insurance are not going to populate and put your purchase, in jeopardy. So thank you, Julie. Those are some really good examples. So let's talk about some things that are out of the control of the buyer. We talked about some things that were in control of the buyer, 5 of them. But things that are outside the control of the buyer. I have it here: title and documentation. Do you want to talk a little bit about title and how liens affect the closing?
Yeah, so title is a very title is something that closes, that's definitely that 5%. Where you could run into a title issue is, let's say there's a husband and a wife that have lived in the same house for 20 years, and they live this beautiful life, and everything's great, and then they pulled, what is it, Arnold Schwarzenegger? They pull an Arnold Schwarzenegger, and what happened was, the dad, got together with the maid and had another kid. Well, that kid is allowed, that kid can have that house. So at the end of the day, you can't sell that house unless that child has access to the house as well. So that could run into a problem. So that's what the title insurance does, is they go out and they look and they make sure that no one else can claim title to that house. And if they can, then you might run into a situation that'll take more than the 30 days to close. You may run into a 3 or 4 month like probate kind of situation.
Yeah, it's true. We see that a lot too with older people. They sign documents that they're not aware of, really what they said. They transfer ownership or partial ownership. Another one
Yeah.
is, foreclosures, not paying your mortgage,
Yeah.
right? Or not paying your
Not paying your
HOA on
taxes.
time,
Your
not paying
taxes.
your taxes,
Mhm.
right? And these
Yep.
are all liens that are put on the backside that maybe the owner knows about, doesn't know about, forgot
Yep.
about, but
Yeah,
title's
there's
going to
also
bring those out.
liens. There's construction liens that can, be in the tens of thousands that have to be paid before you can close. There's most of the time what I see, what doesn't close, that's has nothing to do with the buyer, is condos. So condos are like a whole beast. Townhouses, condos are a whole beast, because you have a HOA that's running it. You have all these people that are paying into the HOA. I had a loan that didn't close a couple of weeks ago, and the problem is they didn't have insurance on the HOA. And what that is let's say this HOA, the president of the HOA is holding on to almost, I think that their budget was $975,000, right? And the president can sign checks. They can sign checks all day
Yeah.
on that. And what else they could do is they could go to their bank and write a check to themselves for $975,000 and move to Bora Bora. And every single person that's in that building would now be responsible for that $975,000 if there's not insurance. Well, as a lender, I'm not going to put us at risk, and I'm not going to put you guys at risk as the buyer, where if something like that happened and you don't have insurance against your HOA and they're the ones that are running it and they're a private entity, most of these people have a day job and they just do it on Saturdays. They only come into the office on Saturdays at noon. But there is things like that happen, and that can cause you not to be able to close.
Yeah, that's a big one. That's a big one, and we definitely will go back to condos on a
Yes,
different
that's a whole
podcast,
nother
because we could spend days talking about
days.
condos, days. Oh my gosh! But single family homes, we don't have that many issues. But title is important. Sometimes you hire a contractor and they put a lien on your home, which
Yeah.
is normal. But sometimes they forget to remove the lien.
Right.
So title's there to help you remove that lien, and then you move on to closing. So that's not a big to do.
And
But
sometimes that is what causes the delay, those delayed
yes.
closings, because then now you have to reach out to them and make sure that they get it off. And that could be a week to 2 week process.
Mm-hmm. Yes. And remember, even though we say delay, and delays were what, 22%, I think? Yeah,
Yep. 22.
22%, that still affects the contract. And delays still have to be approved by both parties, the buyer and the seller. And so delays are risky. It's not
Yes.
just a delay; it's risk. And then 5% non-closure. So Julie, I know you have a great product for your lending where you guarantee loans. Tell us a little bit about that product.
Yeah, so we underwrite our loans in the beginning, which is super helpful for the sellers and the buyers and everything like that. So that what happens is we do it like it's called 100% credit commitment. So even before you start looking for houses, we make sure that your debt to income ratio is good. We make sure that you really do work at your job. We make sure that the money you bring in isn't just like a random bonus that you get every so often. This is real money that you can really deal with. The underwriter actually looks at your loan before the loan even goes into effect. So one of the reasons that a loan, maybe wouldn't go through is that they pull what's called like a hard pull at the end just to confirm that you don't have any major issues. So let's say you owned a business and the business bought a property, but the property wasn't technically in your name, but it was in your business's name, and the business was connected to your name. The underwriter is going to see that. So the underwriter is going to be like, "Whoa, this you have to pay. You're in foreclosure. You had a foreclosure." And so if we can see that before you even start looking for houses, that's going to save you time and energy. And most of the time something like that isn't found out until the end. That's not found out until the underwriter sees it at the end after everything's already done. So if you can stop all that in the beginning, that's the key and the bonus to it so that you know what's going on ahead of time.
Thank you, Julie. That's a great product you offer. We don't want to get to the closing table and not fund.
No.
So, taking care of all that risk on the top. So let's recap. There are 5 reasons why a loan does not close. The first one is you made a big purchase. We don't want you making big purchases. The second one, you take out more credit. Do not take out more credit. It's not worth it. It can jeopardize your loan. The third one, let me just go back to my notes, job loss or change of employment. If you're thinking of changing your employment, talk to your realtor, talk to your lender, make sure that one, it's okay, and two, if it's not okay, postpone it. You don't want to lose your dream home because of a job change. The fourth one, the home appraisal process. Make sure that between the home appraisal process and the home inspection process, you're working with both your realtor and your lender to make sure that you're negotiating. And if you can't negotiate to where you want to be, whether or not you can still fund that loan. And if not, you can go ahead and remove yourself from the contract and take your deposit within the terms of the contract. But, we really want you to be able to buy that home. And we work very hard to make sure that we're doing everything possible for you. So the bottom line is that 27% of loans are at risk. 5% do not close. And most of that is due to buyer choices. So we hope that on this video and this podcast, Julie, thank you, that we hope that on this podcast, we enlightened you to the 5 things that you should never, ever, ever do once you are in contract. Julie, any parting words for us?
If you do want to do it, just talk to us and we will help you navigate yourself. Because if your debt to income isn't bad, you can do it, but you have to ask us first.
That sounds good, Julie. You're right. Ask, ask, ask before you do anything once you are in contract. Do not be the 5% that fail. We want
Yes.
you to be the 72% that succeed, have a stress-free transaction, and are happy to receive those keys and move into your new home. So if you have any questions, if you would like to schedule an appointment with Julie and I'll have the link below as well. And reach out to us. We would love to be able to help you and be your partners in the home buying process. Julie, thanks for showing up today, and thank you for all the great information and the wonderful examples.
Anytime.
Okay, everyone, we'll see you next week. Bye.
Happy Monday. Bye.